Hello, ladies and gentlemen around the globe. This is Timothy Green, stock market
What sort of volatility do we see in the first
investment
half of next year,
bond
given
school.
that there is going to be this tightening that goes on, and what
And I want to
assets
hit
are
you
most
up on
vulnerable to it?
what's really going on.
So, Karina, that's a great question. And what we do,
See,
when
you
talking
can't
to advisors,
control
is
the
really
market.
get into the
You
portfolio
cannot
role and
fix
try to
the
understand
market
how
when
sensitive
it's
is
not
it
broken.
to shocks like this, or
But when
potentially,
you make
even greater volatility going into the new year.
the
And
right
if you think about it, there are
investment,
more things than just stocks and bonds. I mean, there's other
then you can keep up
innovations
with
that
the
have happened in the
market.
market in the last
So let's
10
listen to
years
these people
that
and see
really
what they
help
got
long-term
to say.
investors cushion that volatility, protect income.
And
I'm
I'll
talking about
try
products
to do the best I
ranging
can to
from
walk you
fixed index
through
annuities to structured
of
products
what's really
to
going
even
on,
some of the most easily
how
attainable,
we
which
all
are
can
buffer ETFs.
profit
So
from
I think
this
it would be
by understanding
a service to investors to
how
talk
the
about and
needle
learn about these products
works
because they do offer a certain
and how
diversification
it
that simply
plays
bonds
its
don't offer right now.
parts
And if you're thinking about
on the
protecting income,
line
I don't think anyone's telling you
of
to run in
numbers
with both feet
through the
into fixed
years
income.
that it
I gotta ask you
has
about
been
your
hyped
outlook for inflation as it affects
on
all
a
asset
straight
classes
level.
and risk markets. What do you see happening? I think
And
the
wherever
transparency
it
is out the window. Even
lays,
Powell says we're not talking about that or using that terminology anymore.
well,
But
we'll
at
get back
what point
to
does
you
inflation
on that
peak? Do you
because I
think
can't give
in
away
the
too
coming year?
much
Well,
because it's a
inflation is real.
balance
I
of
mean, I
up and
experienced it
down
last
when
night
it's
having
high
dinner in
and
the
low.
city at
But
a
when the
very well-known
economy is
restaurant
seeing
where the
trouble,
prices seemed a little bit bigger.
deflation,
And
and it
had a little
drops
technical
and it
issue with the
drops
credit card, but
below
otherwise,
zero, and one of them
it's
lines,
just more
it's
expensive,
a
and
year
there's no way to avoid it. We
of
just saw the
inflation.
CPI with a 6.8 handle, and
Well,
that's real. People do feel that.
that
Whether you're out to dinner or you're in the
isn't
supermarket,
your
there's
inflation,
no way to
but
avoid
it
it. I
belongs to
don't think it
someone
goes away
else, and they
anytime
still
soon,
got to pay.
especially with the
And it
spending
picks
goals
up
that we
that
have.
slack.
But again, I go back to
Within that
volatility and
money
understanding how you're
is
positioned
taxpayer
for
a
2022.
percentage.
We've got
Within that
elections coming up. We've
percentage,
got Fed decisions. There's a lot
it's
of
going to
things going
add
into
on to
where
the
investors really
percentage
need to focus on volatility,
that's going to
how to
be
protect
added on
income,
for the
and how to
market,
diversify not
because
just
the
with
market
stocks,
pays of
single
money,
stocks and bonds, but with other more innovative products
and you got
that
to
will
pay the
actually
market
behave the way
if you gets
a
it wrong.
portfolio manager would behave. And
Understand
these
what I'm
products do
saying?
exist, and I
That's why it's
urge
a high and low.
advisors to teach their
But
investors about
understand
these
what's
things
going on.
because
We listen
we
to
do
these
have
people, see what they
an
saying,
unbelievable array of products
and they
when
can
put
beat
together
around the
correctly
bush
will really
all they
give an
want
investor,
to
certainly
try
over
to
the long term,
understand
a much
all the
easier
education in the
way to sleep at
world,
night.
all the
Attorney
knowledge
Danielle
of
DiMartino, who is
reading
Quill
the
Intelligence
GP
LLC
and
CEO
all
and
what
Director
they
of
believe.
Intelligence. Danielle, you saw Brian sort
But
of
the
lay out
truth
the
of
case
the
here.
facts
Certainly the
of the
market
matter
anticipating
is,
this accelerated taper timeline.
when you have
How
a great
aggressively do you think the
investment
Fed
in
needs
a
to move?
person
Well,
that have money in
the
the
Fed
bank
needs
and you borrow
to be
their
more
money,
measured than it's being pressured to be, and
and then
specifically pressured by
you taste their
politicians.
money
So we have to remember that Jay
and you
Powell has
try to
been one of the most
cover it up,
active Fed chairs in the history of the institution in terms of
and his
how often he's
portfolio
up on the
speaks
Hill
for
and how
itself.
many people in Congress that he's visited
And no
with and the
matter
meetings that he's
what
had.
you
So
come up with,
he's feeling tremendous amounts of pressure to try and attack this
it's
39-year high
not gonna
in
be
inflation.
what
And
you
you actually,
think
if
it's
you're looking
gonna
specifically
be.
through the prism of
You
goods
got some
inflation,
years to
of
pay
durable goods items
before
that we
and
buy,
after.
you have to go back to 1942. Not back to
And
the
you
70s
gotta
and
pick
80s. You
up
have to go back to
the
1942
the
before you can find other inflation prints that have been
certificate
this high. And of course, that was a time that we
for
were
the
at war
delay
and there were major supply
of
chain
the death
disruptions for other
certificate
reasons.
on the
But again,
market
this is very
of the
problematic, and I
percentage
think he's
that
going
you
to
gotta
have
add
to
to
listen to some of
this.
the voices in Washington. And to Brian's point,
And
are we
if you
going to
don't
see
understand the
the
market,
Fed
don't get
chair
in it.
who we saw in
In the old
2018?
days,
And in December of 2018,
when you make a
he was
bad
very
investment,
upsetting to the markets, and we forget that.
people
This was
used to
prior to the Powell
hurt
pivot.
themselves.
Danielle, I mean, as a
'Cause
former Fed official yourself,
they
it's
made a
pretty
bad
interesting,
investment.
the timing of all this,
And
too,
when
right?
that
And it's probably the worst
money
policy
add
year
up
to be
with the
coming off of a really
percentages
tense when
and
you've got Omicron and now
what they had
cases
to
in the
pay
UK hitting a daily record. I mean, that's a
before
big
and
unknown.
after,
And so even though the market might
or
be
you could say
anticipating some of these things, it's still a large question
yet
mark
to come,
in terms of whether or not now is the
hey,
time to be shifting a policy stance. I mean, how
they
difficult is
mind
that
went
for
boom.
anyone at the Fed,
You understand what I'm
not, to
saying?
manage a decision like
So
this?
let's get this
I do not envy
school
Powell at all. I don't envy
on
the
board
individuals on the committee.
so we can
I would
learn
hate
not
to
to
be having to
make
put my
these
dot on the
mistakes
dot plot
what
today.
they trying to cover
Especially on
up
the day when retail sales come out and
when I
figures
need my money
retail sales,
today,
which exclude
because my
building
money
materials,
was in the bank
autos and gas,
today.
actually
It should have
contracted
been
last
still
month.
there.
I mean, that's the last thing you want to see. Even if you want to argue
Let's
that a lot
listen to
of
this.
the holiday
Check it
shopping
out.
was pulled
No matter
forward
what
into
they
September
say,
and October, even so,
the
you
money
don't
should
want to
have been
see
in
a
the bank.
negative
It's
print on
against the
retail
law to
sales
rob the bank.
while you're anticipating a rate hiking cycle, possibly. And
It's
you've got
against
a
the law
lot
for the
of
bank
hawkish
to rob
members
you.
rotating
If
into
they
voting
can
in
peace
2022.
the
So Powell is also
president,
dealing with the specter
they
of
can
not
peace
one,
a
not two,
state
possibly 3 and 4 dissents
for
at any given
messing up
meeting
the
if he's not
economy.
willing to accelerate the pace of the tightening.
Let's listen to this.
Danielle, there is a question about, whether in fact the market expectations match where the Fed actually is. We've had a few weeks now to sort of think about that testimony from Jay Powell where he said he was essentially retiring the word transitory. You've highlighted the expectation right now is for that first rate hike
I
to
heard
come in
enough.
March.
I'll get back with that. When you got transitory, it's mean more than one and one and more than one and two and three. It's just transitory on your portfolio from the money in the bank, from the item for each and every item or each and every taxes and each and every percentage. Why do you call it what you call it?
So the difference between the 2-year treasury
Understand
and the 3-year
what you're
treasury,
saying.
we spoke about for
This is
like
money.
an entire year in
The stock market
2019.
pay out automatically.
That is problematic all
And when you
over again.
tell
We
them
see
to
it go
send it
from
to the bank,
160
it's in the
basis points,
bank.
1.6 percentage points to 80 in the space of 6-7 months.
Excuse
That's the
me.
fastest we've ever seen.
I'm not smoking enough cigarettes.
And I would hate to have to be Jay
Understand
Powell
what I'm
and
saying.
say, come March, the yield curve might
That is part of the market. Tobacco, when you had the crop, there was a lot of money going out. That tobacco was being transported across other nations.
The market is anticipating and what the Fed may be able to
They
deliver.
had to pay a price.
And
And when they get it there and they manufacture it, they had to pay a price. And when they had to labor it, they had to pay a price. And when they had to box it, they had to pay a price. And when they had to put it in the store, they had to pay a price. And when the customer come and buy it, they had to pay a price.
What do you assess in terms of
So what's my price for them delaying my money, taking my money out the bank?
We don't talk
Well,
about it as much.
the market
because
will
there's
tell
no
you
more
that
supplemental
itself.
unemployment benefits
The
and
treasurer
there's no more rental eviction moratorium. But there are
just
still
got to
some very
make sure
significant sources of
they
fiscal
come
stimulus
up with
that
the
are
right
helping out
amount,
the lowest income earners right now. And
because
what happens in
they
2022
already
as we turn our eyes
done
towards the
gave
midterm
them a
elections
bailout.
and moderate
They
Democrats such as Joe
refuse.
Manchin, John
So
Tester of Montana
once you
Cinema,
refuse the
it becomes
bailout,
very important whether or not this fiscal
so
relief is going to
if I
continue
owe
in
a credit
monetary
bill
form, like
some
in cash
money,
deposits into
and
the
the
year
credit
ahead,
bill
that's
say,
not the
well,
case.
pay
And we're seeing
7,000,
retail
and
retail
you
sales
say,
slow.
nah, I'm not
Again,
gonna
this
pay
is
that
it's
7,000,
a
and
very
the credit bill break it
situation
down for
because
you. Okay, he ain't got
consumer has been a
7,000,
source of
so
strength
let's take
this
it down
cycle,
to
post-pandemic era.
5,000, and then no,
Auto
I ain't
sales
gonna.
have been
But
very
if
strong.
credit bill say,
Auto
look,
sales are
I
off
don't know how
7
low
months.
can we go?
At some
So
point,
let's
you
go
cannot
down to
ignore some of the red flags that are being
3,000.
raised by the consumer when consumption is 71%
But
of
understand,
U.S. economic output.
Let's talk more
it
about the fiscal
doesn't
cycle
matter
because
because
we have
once
seen President Biden getting
you
hit pretty
pay
hard
that,
as we see
the
inflationary pressures
overlaps,
pick up. He has
you
argued
have
that
to pay
they've tried
back.
to move
You
the
still
shipping
have to
along
pay.
at ports
You see, I had A1 credit because every last one of them banks that I had, my credit was clear from each and every one that I didn't owe no money. Because, matter of fact, because when I got that money, my credit was clear, paid, automatic, paid, boom. So how in the world, under supplemental, you gonna give me a high rate from borrowing money from the bank that I have money in the bank way before when the after we're talking about the most essential when two laws just fully favor my decision that they owe me money anyway, and they refuse to pay. So if you refuse to pay me that money, and then and the middle income earner as well that is not that does not have access to a lot of these government benefits. So I'm of the opinion right now that we need to take a pause when it comes to fiscal stimulus and step back and say any stimulus and tell me I got a high interest credit interest rate for owing money off a small telephone.
And you've been listening to our commentary here. What's your initial reaction to this?
That they add something on and they're not supposed to add it on.
Concerns about inflation. So we see that
I
with
mean,
the upward revisions in terms of the summary of economic projections.
they really was trying to jam me up. But see, in the system of the market, it's a good thing to be in. Because when the state tries to pull one over on you, the market will pick it right up and let them know, no, we got you. Understand what they saying.
Purchasing power. The steps they took today, is it really going to take 2 to 3 years to see that really materialize? Or with the dollar going up in value just by an announcement that tapering will be faster, doesn't that help me as a consumer and as an investor?
I think given the inflation that we're seeing today, the impacts of the dollar are going to be pretty limited. So, you have to remember when we think even in import prices that most contracts are already priced in dollars. So I think the efficacy there is limited. I think so much of this comes down to the overwhelming consumer demand that we've seen in the wake of the COVID pandemic and just the issues with supply chains and manufacturing globally, keeping up with this, creating this inflationary bout. And so I think it is going to take some time to essentially normalize these patterns, and with that, some tighter policy.
And I wonder, from the announcement, it says job gains were quite solid according to the decision. How close are we to full employment? And do you think the Fed has abandoned that part of the mandate to some degree to focus on inflation?
So I think they are giving more weight to inflation right now, given that it's what's really out of bounds with its goals. And the fact that we have seen this improvement in the labor market allows them to focus more on the above target inflation. So they're not having to weigh one versus the other quite as much. But given the fact that we have seen the labor market tighten tremendously, even in just the past few months. So over the past 3 months, we've seen the unemployment rate drop a full percentage point. I think that has allowed them to focus more on inflation for what seems to be quite a change from what we've seen over COVID and really the prior cycle.
And Sarah, this seems to be a somewhat hawkish report, but nevertheless, I'm looking at stocks and the initial reaction is to the upside. Also saying that given the fact that the members of the Fed are expecting 3 rate hikes next year. That is the median number. The Fed OIS swaps, I'm just reading this headline right now, is now reflecting that. So what are the odds that the market is just comfortable with everything that's coming down the pike here, including potentially 3 rate hikes next year?
Well, this is a big shift from the September summary of economic projections, but it's not necessarily a big shift from what the market was already pricing in ahead of today's meeting. based on some of the more recent commentary that we've had from officials and the recent data. So markets were already, roughly pricing in 2.5 hikes. So the fact that the dot plot shows 3 for 2022 isn't that much of a change. When we look at where the median rate is for 2024, it's not much higher than where it was prior to this. So I think what we're seeing here is that these changes were well telegraphed, and so I think that's at least helping for now. Things seemingly stay pretty smooth.
Sarah, when they say that inflation is basically the result of the supply-demand imbalances, are they missing something with the tremendous amount that they're holding on the balance sheet? And when
Yes,
asked about this,
the
what would you
post
want to hear his
office.
response be?
So I think in terms of those supply
Oh,
and demand
don't
imbalances,
forget
comes from everything from the amount
the
that
hospital, the
households are spending
clinic.
on goods, but also even what's considered services like housing. So the fact that we have seen preferences
I know
shift
the
in light of the
introduction
pandemic.
of my
Now, part of
portfolio
that strength in housing costs,
way
that is
under the
one of the
dollar.
factors fueling the more
Oh,
recent momentum in inflation,
haven't I told
is
you?
from the fact that we have
I
seen such
have
low
the
rates that's
perfect
allowing these
portfolio.
higher prices. And so I
I'm
think
gonna
that
teach
does
you
play into it to some extent.
how
For some
to
help on that,
become
we're joined now by Ed
the
Al-Husseini, Columbia
best
Threadneedle Investment Senior Interest Rate and
perfect
Currency Analyst. Ed, it's great to see you. So as we kind of figure
investment.
out what to make of the Fed
So
here,
that way,
something that we have
the
been
next
consistently surprised
time,
about is the sort of lack
if
of
it ever
movement
get fixed,
in rates.
when it
Yes, we've seen
get
more movement on the
fixed,
short end of the curve,
then
but
if
even
it do, then
so,
I can get my
given that
equipment.
we're going to see
I can
tightening at
get
some
all
point,
the
what do you think
Gucci
is
stuff
the
that
cause of that?
the weirdo. I
Yeah, so
could
a
put
couple
it on
things.
the big
One,
screen
on
for
the
you,
front end, we've done a relatively good
and I
job
could
of
walk you
pricing in
through
this pivot from the Fed
of these
really over
old
the course of the past 3
videos
months or so. So the
that
Fed's
where they
recognized that
confuse
inflation
that I
surprises the
can
upside
show
relative to their
you
forecast,
to help
relative to
you
market
to
forecasts.
make the best.
They have
I can't
internalized that
tell
by
you,
accelerating the
I
taper,
can't
and
give you the
they
answer,
signaled that almost as soon as they announced the taper
but make sure
in
you understand
November.
that you
And we've been
make
moving
the
into a
right
space where the
investment.
thresholds
Now
for
check this out.
both
Listen to
taper
her.
and hiking rates next year is coming into view. And so I think that's been consistent with the front end repricing. The longer end, of course, is hostage to a lot of secular factors that really haven't gone away, and if anything, have intensified in the course of the pandemic. And so the curve is flat.
Ed, what's the give us some trades here? What's the hot trade post Fed this morning?
The hot trade. Well, look, I'll say in the interest rate space, the front end of the curve, think about the 3-year point, the 5-year point on the curve, offer very attractive carry. And when you're looking at a curve that's relatively flat, what you're looking for is risk reward across different maturities. And at this stage, I would say the 3 to 5 year segment is very interesting. The risk to a position like that, being long, being exposed to that portion of the curve, is that the Fed has to tighten very aggressively and tighten financial conditions in the course of the next year, right? So something they've been hesitant to do, something they signaled yesterday, was premature.
This has
That would
been
be
a
the risk, but for
Timothy
now,
Green
that carry is available in the front end.
investment
And
stock
what about, we were
market
talking earlier in the show
and
too about the
buying
differential,
school.
the spectrum that we are now seeing
I will
between the
get
big
back
central banks,
to
right?
you
With
with
the Bank of
more.
England today saying
Watch
it's going to be raising
this
rates,
for a
the
whole
Fed's
month,
sort of in the middle, and then the ECB saying
and next
probably
month
not happening in
it'll
2022
be
for
another
us.
one.
So as a strategist
Cause
and analyst,
hey,
how do you sort of take advantage
you
of
gotta
that
get paid
differential?
by the month.
Yeah, absolutely. So
Why they
we
have
had
to
a
pay
really
by the
nice
week?
run in the dollar because
When they gotta
one,
pay by the week,
the Fed pivot got priced in, so U.S. front end rates rose. But I think
they
equally
have to
importantly, the U.S.
give
economy has managed to
by the
surprise to the
day.
upside in the course of the
As
last
they gotta
several
give
quarters
by the day,
relative to Europe. Europe
the
and the
hours
UK
of time
saw a bigger
is gonna
downside
be
from the
counting
Delta
the
wave
percentage of
and
the
are seeing
amount
a
of
bigger
money
downside
of the
now
idols
from the early
that's
stages of
gonna need
this
to
new
be
variant.
paid
So that growth
for
differential got baked
each
into a
and
stronger
every
dollar. I think that
transitory
trade is to some extent coming to an end.
introductory of
So
the
particularly
bonds and
versus the pound
stocks
sterling, you see the pound sterling moving
in the
sharply higher
market.
today. That trade probably has
Hey, I'll get
some
back
legs.
to you. It's a
But
lot to
more
learn.
broadly, taking a
I
step
can't
back,
give it
dollar
all up.
strength probably isn't
My
on the
video posted
cards
is
to the
short,
extent that we saw it,
but
the
it's too
past 3 to
long.
6 months. We'll probably see a
I gotta
flatter
go
into a
through all
weaker
that
dollar
work
in the first half of next year.
to make
I've had
The
several
longer
Australians tell me to
video.
expect a rate shock
I'm not trying to get
next
paid
year.
for this.
Do you
I'm
expect
trying to
something
help
like
you
that, and what would that even look
to get
look
the
like to
money.
you?
Yeah.
I'm waiting on
Well,
that.
I
Hey,
would
let
kind
me
of
get
highlight
back
two
to you.
tail risks, right,
Holla.
from here. We're priced for a relatively